Why would I take a loan for my whole life insurance policy? It's because my money keeps on earning interest or my cash value continues to compound. I'll walk you through a quick exercise that shows using money that's just sitting in the bank, leveraging real estate, and then also using a whole life insurance policy. And I'll go over the benefits of the compounding. So starting with just using money in the bank, which is what most people do. If you've got 100 grand sitting in cash, let's pretend it's earning 5%, and you need to pull $50,000 out for an opportunity, what happens? Well, you took that 50K out, you might earn a return on the opportunity you're looking at. However, you're left with $50,000 in your bank account, and that 50K is what's earning 5%, which means the 50 you pulled out, you have what's called a lost opportunity cost. So what most people do then is rebuild their bank account back to the 100K balance or whatever their target amount is. So that's what most people do when it comes to just using money in the bank. Now, you'll see a lot of people also leverage real estate. This can be really advantageous, and it also has some nice tax benefits as well, but I won't talk about the tax benefits here. So let's assume that instead of having 100 grand in the bank, you have a $100,000 property. And we'll assume that the fair market value of your real estate appreciates by 5% every single year like clockwork. We'll pretend that it's a perfect real estate world. I know that actually won't happen. So you decide that you need $50,000 and you're going to take $50,000 in the form of a loan against your real estate. Now, we'll pretend that the cost to borrow is 5%. So that is interest that you're going to pay to the bank in this particular case. Now, the advantage to taking that 50K from your real estate is that you continue to earn that 5% appreciation on the full property value, or the 100K in this case. Now, away from our fantasy world with respect to real estate, the appreciation is based on the real estate market, as we know that that can fluctuate. However, over the long haul, we have seen real estate values go up over time. Now, the drawback to some is that when they take a loan from the bank, the property is what's held as collateral. That's how we're getting that loan from the bank. Now let's look at a whole life insurance policy. So we'll use the same $100,000 example, and we'll assume that your cash value is valued at $100,000, and it's compounding by 5% per year. You need $50,000, so you take a policy loan from your life insurance policy. The cash value is the maximum amount you can borrow. So you take 50K, and the interest rate might be the same 5%. Rates range from 5 to 6% as of June of 2026. But that 5% interest is paid to the insurance company. However, the 5% growth rate, or let's call it appreciation, to keep it consistent with the real estate example, you still receive that on the full $100,000 as if you never touched the cash value at all. The reason why is because when you borrow against a life insurance policy, dividends are still paid on your entire cash value, not only the remaining equity. It includes the amount that is not borrowed and also what you've borrowed against your policy. How the insurance company does that is, one, there is a cost to borrow, that's the loan interest, but two, they also collateralize your death benefit dollar for dollar by the amount that you loan. Now, another big reason why people use life insurance loans is it is a private contract. There's no creditors, there's no credit reporting. It's not going to impact my credit score at all. And I can pay loans back however and whenever I want. In a lot of cases, you could even not pay it back at all. But let's take a look at an example of an actual policy and what it looks like without loans, and then what it looks like if we take a loan and pay that loan back over time. So here we've got someone funding a large whole life insurance policy with 100K per year for 10 years. Now, if you look at those numbers and think, hey, that's way too big, you can take a zero off. It's all relative. You can even add a zero. You'll see very, very similar results if you just scale it up or down. So first year, 100K goes in. First year cash value, $92,000. That's the drawback, by the way. That first year hit. We always want to minimize that, but that still is the hit. Now, you make up for that quickly as we are cash positive, meaning we have more in cash value than what we paid between the third and fourth year. So this shows what the policy is growing by. And when you look at that yearly growth column, that shows the net dollar amount you are receiving from the insurance company on a year-to-year basis. It does not include the amount you're paying as well. It's simply how much did the insurance company give me? That's the total dollar amount I want to know. Okay, so we've got that, and we will look at that again because that's important when we analyze loans. Let's look at this exact same policy, but with a loan coming out. So you can take loans anytime. We're going to model a loan here in year 11 just because it's after the funding period and it makes the model easier to follow. So here we take a $500,000 loan, and how does that impact the policy? Well, your cash value, you can look at the growth model, comes down by just about $500K. It's a little bit more because the insurance company is also accounting for the loan interest. You'll see that in a moment. But here's the big piece that drops. The death benefit comes down dollar for dollar by the amount we borrowed, meaning pre-loan, we were $2,294,000. Post-loan, we're $1,794,000. It's a $500K drop because that's how much we borrowed. Think of it as the death benefit is what's collateralized, and the cash value is your line of credit. That's how much you have access to. Now you can pay loans back however and whenever you want. In this example, we're going to pay it back somewhat aggressively. So in light blue is your net out of pocket, how much you're paying toward the loan. Really what we did here is we funded it with $100K, then we stopped funding it and just put that $100K toward the loan payment. So you've got a $100,000 per year loan payment, and you can see how much is applied toward the loan interest and how much is applied toward the loan principal. And if we look at the bottom of this illustration, we can look at year 18, but the bottom's just easier in the eyes. What's your cash value? Almost $2.2 million. What's your death benefit? About $3.2 million. And if you compare those values to the values found on the illustration where you just parked it and let it sit and grow, you'll find that they are exactly the same. So what that means is that your cash value continued to compound as if you never pulled that $500K out in the first place. That's the big benefit. Now, the counter argument here is, well, yeah, but you also have the loan interest, so I need to factor that in. You do. And here's typically what you'll see a business owner or real estate investor look at. And if they don't ask to see this, we'll ask the question for them and then show them this, as it's very important. So we can see what the difference is. Specifically, we've got our yearly cash value growth and then the dollar amount we're paying in loan interest. So this lets you see on a year-to-year basis, what is my cash value growing by and what am I paying in loan interest? And what I want to see is more growth than what I'm paying in interest, because that tells me that I'm positive in the policy alone. It doesn't account for what I've used that $500K for. If it's an opportunity, maybe I invest in real estate, whatever it might have been. But I continue to see my money grow. And if I'm earning more than what I'm paying in loan interest, that's a big win-win. And this is typically where we'll see a lot of people use loans. So to answer the question, why would I take a loan for my life insurance policy? The answer is, one, it's very convenient. I get my money quickly, but the big thing is my money keeps on compounding as if I never touched it. Oh, and by the way, that loan is also tax-free as long as we follow IRS rules. I hope you enjoyed this video. Please let me know your thoughts in the comments below. And as always, I hope this helps.